Welcome back. You're watching Your World at 10. Of late, many individuals and entities have come up styling themselves as microfinance institutions and are giving loans to self-help groups at very high or usurious rates of interest and are using inhuman coercive methods for the recovery of the loans. This has even resulted in suicides by many rural poor who have obtained loans from such individuals or entities. Well, that quote does not represent my views, but in fact the explanation offered by the Andhra Pradesh government for passing an ordinance to regulate the state's microfinance institutions. Around the same time, the Reserve Bank of India announced a board subcommittee to look into concerns regarding high interest rates, coercive recovery methods and multiple lending issues in the MFI space. Now, RBI, if I may remind you, regulates only those MFIs that are NBFCs, which make up about 80% of the sector in value, but are a small fraction in terms of the number of institutions that have proliferated across the country. And finally, there is some buzz that NABARD will be tasked with the regulation of non-NBFC MFIs. So you've got RBI, NABARD, state governments, of course, and then there's always North Block. You know what they say about too many cooks? Well, is it going to spoil this broth, or does this broth definitely deserve more regulation? Joining us now is Ramesh Ramanathan, the founder and chairman of Janal Lakshmi. Ramesh has intimate understanding of the microfinance sector in the country, and he joins us tonight to weigh in on whether this sector needs more regulation, if at all, and if it does, whether we're walking down the right road. Ramesh, thanks very much for joining us on Your World at 10. Let me start by quoting you from a column that you wrote in 2008, which said, unfortunately, MFIs are trapped in a maze of schizophrenic regulations and confusing institutional structures which offer few paths to scale and consistent innovation. We're faced potentially by even more regulation, Ramesh, at this point in time, outside of the ordinance that Andhra Pradesh has passed. Maybe we need regulation, but my question to you tonight is that is this more reactive regulation as opposed to well thought out, orderly regulation that doesn't come from either an emotive or political point of view?
Minika, I think that the first thing we need to say is that just like any other hyper-growth sector, the MFI sector, which has really tremendously grown over the last 5 or 10 years, is subject to a lot of what you could call self-inflicted wounds. So what we're seeing today playing out is substantially also the cause of some industry practices, practiced not necessarily by all players, but certainly by some players. So that's something that one needs to state up front, that there are excesses that have been practiced and those excesses shouldn't be tolerated. But I think compounding that has been, as you have described, a range of different responses, some by the state government, primarily I would say by the state government. All that's being played out in Andhra Pradesh is really the response of the state government. And I think the regulator in this case has done a measured job. The appointment of the subcommittee is a good thing. It will look into these issues and hopefully come out with some right recommendations. And they've also kind of already taken in their public positions, North Block as well as the regulator have clearly said there are certain things that are off the table yet. But at the heart of it, which is the multiple lending as well as the coercive methods of recovery and in some cases the excessive interest rates are clearly all combining to create a flashpoint, which is what we've seen played out in Andhra Pradesh.
What's the likelihood, Ramesh, that we might actually in fact see a regulation of interest rates? For instance, the Andhra Pradesh ordinance does not put a number to, a specific number to cap interest rates, but it is very clear when it says that the interest recovery cannot exceed the principal, and where the interest has already exceeded 2 times the principal, the loan stands discharged. Now, this is a cap for all practical purposes. We've had, let's say, Mr. Sarangi of NABARD, who may be tasked with the job of regulating non-NBFC MFI, say he's not in favor of putting a cap on interest rates, but he definitely wants rates to go down. So whether it's by putting a cap or by nudging, pushing, shoving and winking and asking for rates to go down, this constant conversation around rates, is that going to be good or bad for the microfinance industry?
I think that the conversation around rates and job owning the sector to start pushing rates down is a good thing, because you have to recall that the interest rates would structurally go down in a normal competitive environment where there's free price discovery and an efficient market is at play, and that's not necessarily the case in the microfinance sector. So I think that the role of the regulator to really come in and start pressurizing and pushing the sector to start moving downwards is not a bad thing. But regulating it and putting strictures on interest rates is definitely a no-no. That's a throwback to where we used to be some decades ago, and we've all seen what happens with that. It essentially drives the entire sector underground to the informal market, which is usurious, both in terms of actual interest rates cost as well as in terms of transaction costs. So I don't think stipulating interest rate ceilings does anything for the real consumer or the poor in this case. Moreover, I think that the point you made in your opening comments, which is, at the heart of the Andhra Pradesh ordinance is really, if you take each of the individual pieces of what's in the ordinance, they actually act as enormous frictions for the conduct of a healthy microfinance sector. As an example, you need to take permission to actually go out and lend to people. You need to ensure that these people are not borrowing from more than one. This is not like these people are all CIBIL rated. You need to actually go and do recoveries at the panchayat office and not at the home or the collection centers, which is the normal case with microfinance institutions. The recovery period moves away from being a weekly recovery to a monthly recovery, which is a fundamental issue in terms of how rural microfinance is conducted, if not urban microfinance. Individually, each of these is a frictional issue, but if you collect all of them and put them together, they can undermine the essential business logic of the microfinance model, and I don't think that's a good thing. So leaving aside the constitutional issue of is it in the domain of the state government to actually regulate financial activities, I think there's a larger business model issue which is at play here, and I think it's important that for the country that we need to see a healthy microfinance sector. Clearly there are excesses, and these excesses need to be wrung out. And I would actually submit that the crisis that we're seeing now is in many ways a great opportunity to wring out some of these excesses and to come to a new equilibrium in microfinance. A sector that is profit making but not profiteering, a sector which has got the social motive at the heart of a market-based approach, and which is transparent, has governance standards which are acceptable and so on, which a lot of which are not there today. But I think we are throwing the baby out with the bathwater with the kind of excessive regulations that we are creating and the schizophrenia. Who do we really account to? Is it the state government or is it the RBI? And I would suggest that we have a stable regulator in the RBI. Let's go with that and cement the entire regulatory framework around the RBI. I think that would be a good thing for the sector.
Ramesh, I want to ask you, before I move on to the question of how then do we stop coercive measures, how then do we, in some sense, regulate multiple lending. Let me first ask you this question. Is there more baby than bathwater? Is this sector populated with some bad eggs or some good eggs?
It's a good question. It's a long tail. This is a sector which, as you said, there's a large number of players. Many of them are kind of come from the NGO sector, the social space sector, and therefore are not registered as NBFCs, but continue to be driven by the larger social purpose. Those that have come in as NBFCs, there are some good eggs and some bad eggs. It's anybody's guess what that number is and where the pendulum really stops. But those excesses need to come out, and I think it's important to say this is not a monolithic sector, and we need some regulatory oversight to squeeze this out. Let me give you two examples, right? The RBI today, for all scheduled commercial banks, does approve executive compensation. Why can't we do that for the microfinance sector? This is in fact, if anything, a more sensitive sector than the regular normal banking system. So the same cause or the same concern that the regulator shows when you're taking public deposits can be applied even here, because you're dealing with the poor. So you will squeeze out immediately issues of huge amounts of disproportionate amounts of wealth being created either by promoters or senior executives, which is a huge reason for this entire crisis to actually trigger off. You will address issues of compensation in a transparent manner. The RBI can easily say that all NBFC MFIs will have to get their CEO and senior executive compensation approved by them. Those are small things that can be done to address this. Another example is the question of interest rates and profiting. The problem is, and many people like Vijay and others have eloquently talked about this, which is it's hard to really talk about percentages when you deal with small size tickets, because a 10,000 rupee loan over 1 year, which is on average only a 5,000 rupee loan, even if it costs you 500 rupees to go and transact, is a 10% operating cost. So percentages really don't give you the full sense of the true economic costs incurred in transacting on these small ticket items. But you can measure profitability. all of the NBFCs report quarterly audited statements, and you can see the return on assets on these businesses. What's an acceptable return on asset threshold? Is it 2.5%, 3%, 4%? Though at 4% you can be an attractive institution for investors to come in. But you do have MFIs today which are operating at 800 basis points and 10% ROAs. That's clearly unacceptable. So you have instruments that are available today with some creativity where you can suck out some of the excesses of the system and ensure that we have a stable set of rules to play by.
That would mean, Ramesh, that the entire sector needs to come under the purview of the RBI, which currently, from what I understand of the set of rules, the RBI only regulates the NBFC part of the sector, which in value may be very, very large, but in number represents only a fraction of the number of MFIs that function in this country, so to speak. So are you proposing that if there is a bill that is supposed to be placed in Parliament in winter to regulate this sector, RBI be tasked with regulating the entire sector? How do you take away the state's ability to interfere, or maybe I'm using a strong word in interfere, but to intervene, so to speak, such as Andhra Pradesh has happened? That is again a sticky issue, and that's unlikely to be resolved in some fashion easily through a central bill. And thirdly, do you then agree with the Andhra Pradesh model of restricting rates, which does not pin down to a specific number, but it says that you cannot recover more in interest than the entire principal itself?
Yeah, so there's three separate issues.
Yes,
I think that the bill clearly that's in that's being considered to be placed before Parliament, as you noted at the beginning of your show, is meant for the non-NBFC MFIs.
Yes.
I think that separating the NBFC MFIs and the non-NBFC MFIs is a good thing, because frankly it's very hard. There is a long tail of non-NBFC MFIs which are contributing to a variety of innovations that are taking place and addressing some genuine social issues that the space needs to address. But there's a different set of rules by which NBFC MFIs need to play, because they do get more capitalized, they do tend to get larger in terms of size, and they do potentially cause systemic risk. Because if you look at the numbers in Andhra Pradesh itself, the total MFI sector is by any estimates around 25,000 crores. Almost 9,000 crores of that is in Andhra Pradesh. And there's bank refinancing to the extent of almost 6,000 to 7,000 crores for that number. Now that's no longer an insignificant number, and therefore requires some amount of rigorous oversight. So I think that having two types of regulatory oversight is not a bad thing, and having the NBFC MFIs overseen by the RBI with some of these additional elements thrown in, which is on executive compensation and returns and so on, might help to streamline the functioning of these MFIs. When it comes to the role of the state, I think it's a little bit more complex, because I think the argument that a state can legitimately make, as Andhra has done, is to say, listen, when you have suicides and when you have social unrest, that is there's a clear imperative for the state to get involved and do something about it. And there are hygiene principles in terms of rules of engagement which the state really needs to enforce, even if the nature of the business is financial services. And there's precedent for this in other states as well. I think that's what's going on right now. It is a grey line in terms of where does that state involvement end and where does the financial regulation and oversight begin. I think we are seeing that edge being tested right now, and I'm hoping, frankly, that a large chunk of what's in the ordinance doesn't see the light of day, but some components of it, which are to do with business hygiene issues, do continue, because and I think the MFI sector and the leadership in Andhra has already met with the Chief Minister and the senior bureaucrats there and committed to making some corrections, which is like setting up a helpline, like reducing over borrowing and getting registered and so on. The question is, when is this too much? When is it going to suffocate the sector? Unfortunately, my hunch is what's in the ordinance right now is a little too much.
And the final question, Ramesh, which is that do you believe the way Andhra has gone about capping rates is the right way to do it, as opposed to specifying a certain number?
No, I think that they clearly have steered clear of what they would have probably preferred, which is to state a number.
Yes.
This is giving a broad indication, which given that most of these loans tend to be 1 year or at the most 1.5 to 2 years, saying that interest cannot accumulate beyond principal gives enough of a latitude of what those ceilings could be. So it's a kind of an indirect way of suggesting that there is some ceiling, but the ceiling is in some sense beyond the current thresholds of the 24% and all that people are talking about.
So it's fair. Can I say that it's fair the way they have worded it?
Yeah. Yeah, so it's not as significant an operating constraint as some of the other issues that are in the ordinance.
Ramesh, you mentioned this issue needs several more debates. I hope we made a beginning tonight. Unfortunately, we're entirely out of time, but thank you very much for joining us with your views on the regulation required in the microfinance industry.